Hey, before we get started, I want to talk to you a little bit about annuities. There are a lot of bad actors in our industry that try to push and sell annuities, mostly to people who just don't understand how they work. They sell to your fear, which is so true in marketing today. People try to find what are people's pain points, what they fear the most, and they focus on that and selling their product. Annuities are no different. Annuities are great for the people who develop them and great for the people who sell them, but not so good for the people who buy them. You can go to our website, scroll down to the bottom. We have a PDF you can download on why you should not buy the annuity. It's buyer beware. Why are they trying to sell you that annuity? You can learn more there. Enter your email address, and we will send that to you. Thanks for listening. Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
So usually when you pick podcast topics, you look for things that everybody's talking about. Today, we chose one that nobody's talking about, and that's gold. Nobody's talking about gold. So I thought, hey, maybe we should talk about gold.
Nobody but us.
I haven't watched TV in a while. Does Fox News still have all the gold advertisements in between?
Yeah, there are always these older, aging actors that do these. It's pretty interesting. So, there they are. I haven't seen them in a while.
Late night commercials, they have a lot of those targeting people for sure.
The gold?
Yeah.
The gold ones? Interesting.
Buying gold, buying in your IRA, which is a terrible idea.
Don't give it away yet. I remember back when I was in aviation and I was the Airline Pilots Association 401k specialist. And I remember standing at the computer to check in, and I remember this guy walked up and he says, I want to liquidate my entire 401k. How do I do that? So we sell and go to the cash fund, right? And he's like, no, I need to get it out. I said, well, you can't really do that until you separate from the company or you're 59 and a half. So you're neither one of those. So you can't. So what are you trying to do? Thinking, he's in dire straits or something's happening. He's like, I'm taking it all out and I want to put it in gold and bury it in my backyard. And I laughed, but he was serious. He actually would just put it all in gold and bury it in his backyard. And I was like, wow, you fly $1 million airplanes. This is scary.
The alternative to hiding on your mattress is burying gold.
I guess. I mean, part of it, I kind of walked away. It's like, man, that's kind of scary. And then it's like, well, but he's very defensive. So that's the kind of pilot you want. Very defensive pilot, right? Just very, very cautious.
Well, this tends to be kind of the investor mindset when you talk to people about gold. It is the concept of taking it, I should say buying it, and then putting it away someplace as if it magically can reappear years later and it's transformed itself into something other than what that hunk of gold was that you buried in your backyard was 20 years ago. And this is kind of a strange investor mindset relative to people who invest for growth and income through stocks and bonds. It's a very different idea.
Let's go with the infomercial for now, and let's talk about why do you want to have gold? Why do people think they want to have gold in the portfolio? And then we'll go through the pros and cons throughout our order of operation here, and then at the very end, we'll tell you our opinion and what history shows of owning gold in the portfolio and why you should or shouldn't have gold in a portfolio. Why do investors like gold? Anybody know?
Well,
it's pretty.
It is, and that's what I was going to say. You can touch it. You can feel it. You can look at it.
Maybe.
You can set it over there on the counter. You can do lots of things with it. People, for the most part, I think, buy gold because they're afraid. Gold is sold by fear of impending disaster, either in the marketplace, in the economy, or in their life somehow. But when you listen to these commercials by these very, very well-trained actors, I mean, these are well-known actors. They're not just there because they have great name and facial recognition. They're there because they can act. And they talk about what the world can be like for those who don't own gold.
Well, nobody reads the fine print, but it says obviously it's a paid actor. But yeah, they're selling the fear, and that gold's a safe haven asset. So, if you buy gold, you'll be all right when the doomsday scenario comes around. I
mean, gold coins on TV commemorating your favorite president or the lunar landing or whatever. Yeah, that's a collector thing, right? But gold in your portfolio, that's really what I want to focus on today. Not the collector gold, not the jewelry, not the one that makes your spouse smile, but the one that's supposed to be in your portfolio to hedge you from this great doom that's coming. I think people think they want it because of returns. It's going to perform better than the overall stock market, right? They think that it's very liquid. They can always get rid of gold, always sell gold, right? And then low correlations, meaning that it kind of goes along with returns. If the stocks are down, then gold's always going to be up, is the theory.
Well, I think that is the theory, or at least the thought process behind it. An individual investor trying to buy gold to diversify their portfolio. But studies are showing that that isn't necessarily the case. They will point to these instances in a market condition where the gold has popped up in a very abrupt manner due to some reaction in the marketplace, that there's a dislocation quite often that would occur that would cause this. But as soon as the dislocation in the marketplace works its way through the system, gold tends to go back to what it was trading before. So in order to take advantage of gold prices that may run in a non-correlated manner to the rest of the market of stocks and bonds, you have to be willing to sell it quickly at the moment where it is achieved its objective.
It becomes a timing mechanism. You
That's
have to be
right.
in at the right time and out at the right time.
That's right.
What was a perfect example of last year during the beginning of COVID? I mean, gold and silver were hitting all-time highs while the market was pulling back 30%. So you saw that specifically then.
Well, in the end, the gold prices fell initially during COVID, but didn't fall as much as the overall market. So then it started rebounding before the market did. But in the end, the market outperformed gold.
Yes.
By the time they got to the end. But at the end here, we're going to wrap this up, and Brad's done the analysis, and you took our portfolio. Which model did you choose? 60/40?
Well, I use the all equity. The idea being that it's an asset class that people would use as a substitute for equity.
Okay.
Rather, because gold has no income, like
Right,
a fixed
true.
income. So
we took gold and 100% equity portfolio and substituted it in. And he'll tell you what happened.
Stay tuned.
If you just want to buy gold because the infomercial, you believe they're more credible than we are, then there's different ways you can do it. You can buy the bars yourself.
Gold
Right.
bullion.
Mm-hmm. Yeah. Different ways of structuring that. I guess there's different types of gold from different countries too, right?
Right. But if you're going to buy, the physical gold, the most important thing there is to buy from a reputable dealer. So the individual who's buying that gold is going to have to do some due diligence on that dealer. And if you buy gold, you are going to have to incur custody charges. It has to be held somewhere. Even if it's held in a safe deposit in the bank, you have that charge that goes along with that. Then you have to audit it, and you have to look at it. You have to make sure that it's still there year after year, or you have to pay a custodian bank to hold the gold on your behalf. That's one way to do it, is to buy the bullion, buy the coins, which you were talking about. Coins are issued around the world. We issue, I think it's the American Eagle coin here in the United States. Another famous one is the Canadian Maple Leaf.
Yep. My father-in-law collected some gold coins, silver coins, mostly from late night TV, and he would buy the 6-pack of the such and such mint. He passed away way too early. He was 64, but been over 10 years ago. My mother-in-law finally decided to liquidate the coin stash, which was boxes and boxes and boxes. Interesting enough, a lot of what he bought over 10 years ago, she didn't get what he paid for it after 3 different quotes from 3 different brokers. So again, it's collectibles. It's not necessarily something you buy to invest in, right?
Right.
Another way you can do is gold futures, if you want to go in the futures market, right? And you do it and actually own the gold, I guess. You own contracts of gold.
Right. This is a very highly speculative trading strategy to be used as a hedge quite often, but by people who literally know what they're doing, why they're doing it, when they're doing it, and how they're doing it. Very complex strategy.
It's very leveraged usually too. You're not putting the full price. So, if the market drops, the futures drop, you can be left holding the bag there. So it can be, like you said, a speculative deal. It's you can make a lot of money. You can also lose a lot of money there. But yeah, it needs to be very sophisticated investors that really understand how futures operate.
Exactly.
Simplest way to do it is our ETFs. That's exchange traded funds. We have a whole podcast on that if you want to look through our history. But ETFs that own gold is another way, probably the simplest way. The Spider Gold Trust, the iShares Gold Trust, Aberdeen Standard Physical Swiss Gold Shares ETF, all would essentially trade for free on most platforms. So you have no transaction costs, and it tracks the price of gold less the holding cost, right?
Right. These ETFs are backed by gold deposits. So it is the closest thing to holding gold without actually holding gold.
We mentioned before how actual gold is based on the market value. You got to find somebody that can actually buy it and sell it. This is an ETF, so it's pretty liquid and exchangeable, which is a nice added benefit to actual physical gold bullion.
The other physical gold, and we touched on it briefly, it actually is jewelry. The jewelry manufacturing industry is 50% of the demand for gold in the world. So it's a huge supporter of the price of gold. But just think about how this conversation might go between a husband and a wife, for example. We say, honey, I'm going to buy you this beautiful gold piece. And she says, thank you very much. And it's wonderful. And she wears it and she loves it. And years later go by, the price of gold has gone way up. And he goes, honey, the price of gold has gone up and we're going to sell that gold piece right now. How do you think the rest of that conversation is going to go?
Such a romantic, Brad.
Well, people who buy gold in the form of jewelry who think that it's going to go up in value, it may, but trying to convert it into cash is a whole other thing.
You buy it at one price, and then you're going to sell it at a much, much lower price if you turn back around and sold it. And it takes a long time to make up that difference.
It just does.
Maybe a generation. I kind of like this one, mining stocks. So at least you own equity in something. A lot of times you're getting a dividend, right? As opposed to gold not paying you anything.
Well, when you're investing in a company, you're investing in the future cash flows of that company. And so whether they're mining commodities and gold, or they're producing widgets or iPhones or whatever the case may be, they're no different in that sense, that you're buying a future cash flow from that company's business operation.
Yeah, and as gold rises, they make more money. They can always increase production, to your point. But because of that, it's also a little more volatile than if you were buying just a regular gold ETF. VanEck, Vector's Gold Miners ETF, and iShares MSCI Global Gold Miners ETF are some of the bigger ones that help invest in big companies that are mining. So it provides a little more diversification than individual companies, but it is still mining focused.
Well, as a business, it produces a product. It produces the gold that it mines. Gold in and of itself produces nothing. It has no cash flows. It has no dividends to its owners. It is based solely upon the supply and demand in the marketplace, which we all learned about in Economics 101, the supply and demand curve. It's volatile. It's difficult to predict any sort of expected return scenario from owning gold in a portfolio. And again, there's custody and carrying costs to go along with it. The interesting about it is also that the people who tend to make the biggest case for owning gold is gold producers or companies that sell gold, obviously. They seem to have the best viewpoint, in their opinion, of owning gold, they're most optimistic about it. This business that we're in, of the financial services industry, in all cases, has conflicts of interest, and that's how we start our broadcast every time, that we think the best advice is conflict-free. But when you're watching these late-night shows, as Matthew put it, and we're seeing these actors talking about buying gold, there's an extremely high conflict of interest there, because they're in the business of selling you gold. And we talked about the difference between buying it and selling it. And that differential, the spread, is as large in gold as it is in any other asset that we know.
So let's go ahead and transition it to 10% gold. If I put 10% gold in my portfolio, tell me what's happened.
This year, you would have earned 120 basis points less than had you not had gold. So that's 1.2%
for those at home who don't understand how Brad talks.
And so as equities have done very well recently, gold has lagged, and they have produced a drag on a portfolio. Over the past year, you would have lost 5% in relative value to an all-equity portfolio. Over the past 3 years, which includes now the depth of the coronavirus and the drop in 2018 around Christmas time, where it dropped 1,000 points in one day, you'd be about even. But over the last 5 years, you'd be down, over 0.5%, in a portfolio with gold relative to not gold. So what this is really sharing with us is that there seems to be very little effect over the long term of holding gold, except for the fact that you have reduced yield in your portfolio. You have no dividends from that 10% allocation whatsoever. So although that's included in the total return, those dividends that are reinvested, they're very real, and they can be used as income, for that 10% of the portfolio. So
now, I don't know if you have it there on the research report or not, but standard deviation, so the risk, did gold reduce the risk inside the portfolio during that time period? Was it less volatile?
Let's see here. Well, the outperformance of a portfolio that has gold relative to a portfolio that does not have gold. So you're looking at trying to gain what's called alpha. The alpha is less in a portfolio with gold. So alpha is a measurement of outperformance relative to another benchmark. So using one portfolio versus the other, as I talked about, the gains over the years are less, and therefore the alpha is less. So you're getting less gain. And in the end, that's really what's important, is how well your portfolio is done relative to your required rate of return. That's brought out in an objective from a financial plan.
Yeah. In the end, return is what you're chasing, adjusted for risk. And we can put this in our show notes if you want to go online and look at it. But my thought is that maybe it's reducing risk a little bit, but not of any significant degree. Because when I looked at the performance separate, just S&P versus gold, gold did tend to be a little less volatile, which I think is what they're pulling out of their infomercials. And mutual funds do the same thing. They're going to pick a time period that benefits them when they show you a benchmark. You often hear such and such has outperformed a Lipper 5-year average by 20%. Well, they got lucky and they outperformed, and they're using that in their advertising. They underperformed for years and years, and then they outperformed in one little segment again. And I feel like that's what happens with gold and the people who are trying to sell gold, because you buy it and they're getting a transaction. They're not advertising on these channels for free. This is not a public service announcement, right?
So, you mentioned the correlations to the market, and I mean that doesn't, as you just said, having a little bit of gold doesn't actually improve the alpha in the portfolio. So just because it's not correlated with the market doesn't really mean it's a good thing.
Yeah, I'm interested to see the on the risk side. We're going to put that in our show notes. If you want to go online, you can see that on our YouTube channel, Wiser Wealth Management, or on our blog on our website at wiserinvestor.com. Basically, though, in the end, to an equity portfolio, there's really no reason to be adding gold. What is a good diversifier versus the market? You know what? This is a question that's been asked for 21 years I've been in this business. Short-term treasuries. If you're worried about the future, buy short-term treasuries. Add that to your portfolio.
Exactly, because those are going to be there, backed by the full faith and credit of the U.S. government. They have a short maturity date, therefore they have a very low duration.
And if you're worried about the liquidity of the U.S. government, then you buy physical gold and you park that in your backyard. You buy ammunition, you buy hard liquor, and you get cigarettes, and you bury it in your tunnel, in your vault, tunnel in the ground, your little hideout. And I'm not making fun. I'm really not. If that's what you're concerned about, that's what you would start building. We have a model for that, the USSR. If you read case studies on what people did that survived during the USSR, that's it, right? Now, for someone in another country, not as great as America, I think there's a case for owning physical gold. Honestly, when your currency is moving up and down. I mean, I've shared this story before, but the quick version is, I'm watching a military channel late at night, and South Vietnamese were escaping toward U.S. ships in their military helicopter. They were landing on the military ships, and then they would push the helicopter into the water, and that pilot and his family now could come to America, right? This guy, he has a helicopter with the 2 blades, Sikorsky helicopter. He's coming in, it won't fit on the ship. Lowers his wife and 3 kids down by rope. Then he backs away from the ship. He does this perfect barrel roll to the right, and he jumps out into the water, and he just disappears. He doesn't show up in here. We're like, dude, they just filmed this guy's death. That's crazy. And he pops back up, and the commentator said that he had sold all his possessions and bought gold bars that were in his backpack. I guess he didn't give it to his wife or kids. He's afraid they're going to spend it before they got to the bottom of the rope or something. I don't know why he didn't hand it over. He couldn't swim with all the weight. Poor guy had to drop the gold bars.
I actually remember the story.
At the bottom of the ocean, there's gold bars in a backpack and some fish going, I don't know what this is doing down here. So yeah, I mean, he had the right idea. He's going to come to the United States, convert that into U.S. currency, and start a new life. Hopefully he came here. He's very successful, and his family's doing great. But
it's a great story.
But in my mind, it was like an aha moment. That's why you buy gold, because I don't live in Venezuela. I don't live in, Peru or anywhere else that has tends to have volatile currency. So that makes sense. But I think where we live and the life that we live, I don't see it. And certainly as a portfolio managers, we don't see the benefit of gold inside a portfolio. If you want to dampen volatility, buy something that pays you some income. It's not much income, but it's more than gold.
More than gold.
And that's U.S. Treasuries. So, well, that was a fun topic, covering things that no one else is really talking about right now. I don't know if we're leading edge or late to the game. I'm going with leading edge.
Yeah.
All right, guys, great conversation.
Always interesting.
Enjoyed it.
Hey, thanks for listening. If you like what you heard today and want to hear more, you can find us on YouTube as well. You can go to Wiser Wealth Management and be sure to subscribe. I do a weekly 5 in 20 with Brad and Matthews, covering 5 topics in 20 minutes that are in the news. We also have our weekly blogs. Matthew's probably our largest blogger in content. You can follow him and Brad and myself on our blogs there, also on our website at wiserinvestor.com. Additionally, if you have podcast topics you'd like for us to cover, we are always open to new ideas. You can send that to our marketing and brand manager, Hadley Glenn. It's Hadley, Hadley, at wiserinvestor.com. Thanks for listening. Make it a great week.